taking us through an introduction where we'll be looking at what exactly is tax. We'll talk about tax. We'll look at the overview of the key taxes that applies to SMEs, because it's very important to understand the taxes that your business will be amenable to and be able to, in order to comply. Then we'll look at the common mistakes that we've seen SMEs typically make. Then, of course, penalties to avoid, because for every default in tax, penalties are likely to accrue. Then we also talk around strategies that will help you maximize the benefits of applying, and then we'll quickly look at some conclusions. So, the truth of the matter in doing business, tax comes with it. It is practically unavoidable. And in the words of Benjamin Franklin, he said, in this world, nothing can be said to be certain apart from debt and taxes, because for every economic activities, whether you own a business or not, taxes come. Whether you buy, you sell, or you even live within a jurisdiction, taxes are a big part of our daily living. And so what is tax in and of itself? So tax is any compulsory payment to governments imposed by law without any direct benefit or return or value or service, whether it is called tax or not. It is a pecuniary burden laid upon individuals or property or businesses to support the government, and it is a payment that is exacted by the legislative authority. Critical things we note here, that it is backed by statutes. So for any tax to be levied upon any individual or a business, it must be statutorily supported. And in the last couple of months, particularly here in Nigeria, we've seen a lot of reforms around the government trying to restructure and revamp the entire tax landscape as we used to know it. Then another thing that is important to know when it comes to tax is that it doesn't mean that there's going to be a direct benefit or return of value or service. The tax authorities, whether at the state level, that's typically known as the State Internal Revenue Service, or at the federal level that is known as now known as the Nigerian Revenue Service. It also used to be known as Federal Inland Revenue Service. There are no direct benefits that will accrue to the taxpayer, to the business that the case may be for paying tax. There may be supportive incentives and all of that, maybe by way of the tax clearance to facilitate doing business, but by way of a direct benefit. And even to get the tax clearance certificate is not because you didn't pay tax. So there's no direct benefit for paying tax. And of course, it is an aspiration of your funds, meaning money must be paid. It's money must leave the business to the government. And that's where the challenge is, because it has to have to do with payment. Now, I want us to just take a view of what has happened in recent times in Nigeria in the tax space. So prior to June 2026, when the Fourth Tax Reform Act, as known today, but it's really made up of the Nigerian Tax Act, the Nigerian Service Act, Revenue Service Act, the Nigerian Tax Administration Act, the Joint Revenue Board Establishment Act. What we used to have in the tax landscape was a situation where our tax statute was scattered in different pieces of legislation. So when it comes to individuals, it was governed by the Personal Income Tax Act. When it comes to companies, we have the Companies Income Tax Act. When it comes to a tax type that is known as value-added tax, there was a separate legislation that is the Value-Added Tax Act that was governing it. And when it comes to issues around stamp duty, we had the Stamp Duties Act. And when it comes to capital gains for disposal of chargeable assets, we had Capital Gains Tax Act. So, and there's quite a lot more. So, and it made tax administration and compliance pretty difficult, not only for the revenue authorities, but even for taxpayers, because it was difficult to try to navigate the obligations because they were scattered in different pieces of legislation. And at times they were overlapping provisions as to penalties, obligations, and there could be conflicts that needed to be resolved, maybe by interpretation or court or what have you. So upon the current the incumbent president coming into office, the president, Bola Ahmed Tinubu, we set up a committee that part of the objective was to ensure that the tax landscape was given a facelift. And it's more than even a facelift, it was a virtual revamp in the sense that there have been far-reaching changes to the way taxes are administered, collected, and accounted for. And we look at this one after the other. So now, as we currently have it, the Nigerian Tax Act is now the consolidated fiscal framework for tax in Nigeria, meaning that all the different pieces of taxes that individuals and businesses are supposed to pay, you find it enshrined in the Nigerian Tax Act. So we have provisions regarding payment of income tax by individuals, by companies, the rates, and how it is calculated is contained in the Nigerian Tax Act as a single piece of instrument. Now we have the Nigerian Revenue Service Act, which replaces the Federal Inland Revenue Service Establishment Act, and is established in Nigerian Revenue Service as a primary collection agency for government revenue in Nigeria, and it also grants wide powers in establishing and collecting this revenue. Another one here, which is the Nigerian Tax Administration Act. So before, as earlier mentioned, all these pieces of legislation also contain penalties and obligations, timings as to compliance. And now all of that has been abrogated within the Nigerian Tax Administration Act, and it governs tax administration, compliance, enforcement, penalties, and of course, taxpayers' obligations. Then lastly, we have the Joint Revenue Board Establishment Act, which provides dispute resolution mechanism, because of course, the tax authority is sitting outside the business. And in Nigeria, we have what we call the self-assessment regime, and which means that the taxpayer is supposed to report its income, its profits, compute the tax, and make a disclosure to the tax authority. And in the place of doing that, the tax authority has different positions they could take. They could accept that returns as filed by the taxpayer, they could modify it, asking for more, and they could reject it outrightly. So it is inevitable that there will be disputes in administering taxes. And so the Joint Revenue Board Establishment Act sets out the mechanism for dispute resolution and, of course, protection of the rights of taxpayers by the introduction of the Office of the Tax Audit. So essentially, in the course of this presentation, we'll be focusing more on the Nigerian Tax Act and the Nigerian Tax Administration Act. Moving on, we'll be looking at the key taxes that are applicable to SMEs. And the first one on this list is income tax. So what does that really mean? So as Oluwasegun earlier explained, the way the business is structured is very critical in determining the kind of tax or how the tax will be paid. So for unincorporated entities that are set up as either a sole proprietorship and partnerships, they are taxed. The profits of the business are taxed in the hands of the owners. And she had earlier explained that because they do not have a distinct legal personality in law, also for tax purposes, they are treated as though it was the owner that undertook the business, which is actually what it is. And then so I'll just give a quick example. ABC Enterprises is into the business of selling smoothies, food drinks, and healthy drinks. And at the end of the year, it has made some profit of, say, 5 million naira. The expectation is that it is the owner of ABC Enterprises that will be required to pay the profit that ABC Enterprises has made. And what is the rate? It is between 0% and 25%. And in determining that, when it comes to income taxes, there are a lot of things that come into play in determining what is actually the tax that will be paid. So the first thing is to determine what is the profit for the year, and you'll speak to that in subsequent slide, because it's very important to know the profitability of the business. The profitability of the business goes a long way in determining how much taxes will be paid. So having determined that is that individual that will be paying the tax. So the profit will be charged depending on the different bands between 0% to 25%. The person will be subjected to tax. And what amount of profit or chargeable income, using the right word, is amenable to tax at 0% is the first 800% that will be amenable to tax. And it keeps on going on and on at a graduated rate, so that for persons having chargeable income exceeding 100 million, they are charged at 25%. Now we go on to companies. Under the previous regime, we used to have companies categorized in three strata. We have them as small companies, medium companies, and large companies. That is no longer applicable. Under this new regime, the Nigerian tax, and what we have as a company is either a small company that is not even liable to tax, or a large company that is liable to tax at 30%. The profit now is liable to tax at 30%. And what is a small company? How is it defined under the law? A small company is a company that has a turnover of 100 million naira, not exceeding 100 million naira, and fixed assets of not more than 250 million. It means that all of its assets, we talk about the motor vehicles, we talk about the property, landed properties, acts, the cars, everything must not exceed it, and it's cumulative. So once it exceeds that, it crosses the threshold and be treated as a large company. Then we move on to another major change that has occurred under this regime, and it's with respect to capital gains. I had earlier mentioned that capital gains used to be treated as a separate tax type, and the applicable tax rate was 10%. But before even going to capital gains, I need to mention that there's a provision in the NCA that provides that the president, subject to recommendation, may still, in sometime down the line, may reduce the tax rate to 25%, and that will bring the tax rate for unincorporated companies, should that happen, to the same as that is applicable to companies, so that you now be at the highest band will be at 25%. Now, moving on to capital gains. Capital gains tax is applicable from when there's a disposal of chargeable assets. It used to be the case that it was any gains that were obtained from disposal of assets such as shares, landed property, copyrights, etc. They were liable to capital gains at 10%. But as a major introduction or change that has been introduced by this reform, is so that chargeable gains that may accrue to any business will now be treated as part of the profit and will be taxed at 30%. Now, how is chargeable gains determined? Chargeable gain is determined by the cost of the asset at the point of disposal. Let's say a company had acquired, say, a landed property at, say, 100 million naira, and then is selling it at 500 million naira because the land and the property had appreciated. And then in the course of the sale, it had also incurred certain expenses and all of that. Then that expense, let's say it's another 100 million naira, it will be considered deducted from the cost of the asset, and then it will now be subjected to tax. Now, it is also important to know that in determining the chargeable gains, there are some other considerations with respect to capital allowance, but I won't be going into that. It's just simple enough to say that capital gains can be determined as the difference between the historical cost of acquiring the assets, less allowable expenses by way of expenses to preserve the rights, preserving the title, improvement of the property, etc., will be deducted from the 500,000, assuming it's an 100, from the 500 million naira, assuming it's an 100 million, minus another 100,000, which was the historical cost of acquisition, and you're going to have about 300 million naira, then to now be subjected to tax at 30 million naira. Now, it is critical to all mention that there are exemptions, and for example, for disposal of shares, there's an exception when it doesn't hit a threshold of I think 100 million naira, and to determine whether it's liable to capital gains or not. Even for capital gains, not actually, the law makes room for certain categories of assets that are quite exempt. And for example, when an owner occupied property is disposed, residential property is disposed, it is exempt. And for other income types that are subjected to tax, those are the things to consider when you are looking at tax planning. What kind of income will be liable to tax or otherwise? Then the last one here under the income tax will be withholding tax. Withholding tax is a subset of income tax. It's not a tax in and of itself. It is an advance payment of income tax. So in doing business, you enter into a contract to supply maybe building materials, etc. The expectation is that on the agreed sum, on the invoice, there will be a deduction by the person that has contracted you to provide those supplies. So, and the whole aim of doing that is to ensure that the tax authority or the government does not wait till the end of the year or the period within which you have to file your returns before they have a sense of income tax being paid. So it's that advance payment of income tax. And some deductions, the rate is currently between 2% to 15%. So depending on the type of transaction being undertaken, it will be used as a credit to offset whatever may be the eventual tax liability of such a business owner at the end of the year. So these are the broad classes of income taxes that businesses are subjected to. And as Media mentioned too, the location of the owner of the business is material in knowing who the taxes rely to. In the case of unincorporated companies that the tax is borne by the owner, it is expected that the taxes will be paid to the State Internal Revenue Service where the owners are resident. For companies, all of it goes to the Nigerian Revenue Service. And by way of statutory clarification, for limited liability partnerships, they are also treated as companies. So in the same way, the taxes that accrue on their profit will also be payable to the Nigerian Revenue Service. And number two on this list is development levy. And development levy is applicable strictly to companies. And even at that, small companies, as earlier defined, companies with turnover of less than 100 million naira, fixed asset not exceeding 250 million naira, are treated as small companies in Nigeria. And it's also critical to mention that for small companies, businesses undertaking professional services are not treated as small. Look at development there before, but for every other kind of companies, we have a tax of 4% of their accessible profit, which will be also payable to the Nigerian Revenue Service. And accessible profit is the profit of the company. And what is the profit of the company? I think I need to also explain that. The profit of a company is all the income that's been generated from your economic activities. So you render the services, you supply goods, all the revenue or the sales that we made within a financial period, typically a 12-month period, is what is allocated as the revenue of the company. Then at the end of the year, you also consider the expenses or transportation costs, staff costs, the salaries paid to staff, or the rent paid for the office premises, etc. And the difference between the revenue and the expenses is what is called the accounting profit. Now, for tax, the accessible profit is a bit different because there are certain business expenses that are not treated as deductible for tax purposes. So it's when all of these adjustments have been made that you determine what the accessible profit, and 4% of that is treated as the development levy. The third one here is value-added tax. Value-added tax is common and is applicable based on how much consumption of products or goods and services are procured on an individual or corporate basis. So if you buy recharge card or data, you are charged value-added tax. And if you buy services say you buy architectural services, you'll be charged value-added tax on taxable goods and services. The Nigerian tax act is quite clear on that value-added taxes are applicable on all taxable goods and services, apart from those that are zero rated or exempted. And zero rated simply means that goods and services that are charged at VAT rather than the 7.5% that is applicable, otherwise applicable, it is tagged at 0%. Then other for exempt goods and services, it simply means that the goods are not liable to VAT at the issue. And we have examples of that in the case of export, oil and goods, or oil and gas exports, etc. That is not liable to VAT. Now, for small companies, I earlier mentioned in speaking around income tax that some small companies have been treated and try to be shielded from the vigorous compliance obligation that is amenable to taxpayers, generally speaking. So in that case, a small company will be exempted from registration, charging VAT, and filing of VAT returns. So they are not mandated to charge VAT on the supply of goods and services that they are rendering, and they are not obligated to file VAT returns, which is typically expected to be remitted to the Nigerian Revenue Service on a monthly basis. Now, another key and critical introduction or change in the tax landscape with respect to invoicing. So the Nigerian Revenue Service the Nigerian Tax Act rather, has mandated that all taxable goods and services must pass through the electronic invoicing system, which of the NRS is called the merchant buyers system. And what does that mean? It means that invoices raised between contracting parties has to meet a specific format and requirements, such as say there's a particular QR code, but more importantly, it has to pass through the NRS system, meaning that for every transaction that is undertaken within the Nigerian jurisdiction, the NRS has visibility on what is going on in the economy. And meaning that also means that the tax authority has visibility on how much revenue has been earned by businesses and how much expense, because one party's expense is like the other party's income. So for the party that is treated as an expense, the tax authority has a first set of how much expenses the business has also incurred. And this is because of the high level of IT infrastructure architecture that is required to drive this compliance objective. It has been faced in 3 stages. The first stage was made mandatory for large taxpayers having turnover of exceeding 5 billion from November 2025. Now, the second phase is slated to be implemented with respect to companies having turnover between more than 1 billion to less than 5 billion, and it's supposed to start from, I think, April this year. And for small businesses, that is taxpayers earning less than 1 billion naira in revenue, it is expected to go live from 1st of July 2027, meaning that all invoices for economic activities within the Nigerian system and even the plans for cross-border transactions have to pass through the e-invoicing framework. The last one here is on stamp duty, that is really applicable to documents such as contracts, leases, loan agreements, etc. We call it dutiable instrument. So documents evidencing obligations, contracting and transferring rights and obligations between contracting parties are expected to be stamped by the relevant tax authority not later than 30 days of execution within Nigeria. And what are the rates? The rates varies between 0.04% to about 2%, and it depends on the kind of transaction or document that is being presented. The obligation is on the obligation as per the law. The NTA sets out the party that is required to present the document for stamping and also provide the rates at which those documents should be stamped. And why is this important? And in business, there may be eventualities so that there could be disputes arise as to the rights and obligations, and you need the court to sanction the sanctity of the documents or the contract that have been entered between parties. And where stamp duties have not been paid, it will not be sufficient, it will not be accepted as documentary proof of the existence of those obligations. So it is very important that dutiable instruments are presented for stamping as when due. And I also need to mention that there are two ways of stamping documents. There's the flat rate and there's the ad valorem rate. The ad valorem rate I earlier mentioned is between 0.04% to about 2%, and for the flat rate is about 1,000 naira. So it's the nature of the contract or the agreement that will determine who bears the obligation and who is supposed to present documents for stamp. All of this is clearly set out in the law. Also, moving on that, we know the taxes that are applicable to business entities. Now, what are the ongoing obligations? So the filing obligation, which is, as earlier said, that the tax authority is not in the loop of what's happening in the business. So the expectation is that on a periodic basis, the taxpayer, the business owner, should present his own records, informing the tax authority of how much has been earned, how much taxes are supposed to be paid, and file the posted returns and also pay the taxes due. The question that now comes to mind is that when should it happen? Returns should I file? Who should receive those sets of returns? I'm going to look at that one after the other. In the case of a company, income tax returns for a newly incorporated company, it should be filed no later than earlier of 18 months from the date of its incorporation or 6 months after the end of its first accounting period. Well, for these companies that are already in business for more than 18 months, then they should have their set of income tax returns filed with the Nigeria Revenue Service not later than 6 months after the financial year end. So it has to be planned and appropriately done. And this comes with a lot of responsibility because in filing the tax returns, it's not a single document, there are computations or calculations that must accompany the returns. Critically, for companies, the expectation is that they should have their set of audited financial statements, which should bear the standard, meaning that there's a layer of comfort or assurance that will be passed on the accounts of the records that will be prepared internally by the company by way of an statutory auditor duly licensed by the appropriate accounting body that was going to give comfort or assurance to say that yes, this account actually aligns with all of the international financial reporting standards and every other associated regulatory demands in order for it, and that the profits or all the information contained therein are accurate or represent fairly what it should be. And that set of return also should have what we call the return, where you calculate from the accounting profit all the way to the total profit and determine how much taxes is due. Then we also have what should accompany, which is the capital allowance computation. All of this has to be done not later than 6 months after the financial year end. And that also carries with it the responsibility for the business owners and managers to ensure that the financial records of the company are put in good stead way before on a continuous basis, so that by the end of the financial year, which is about a 12 months, there's a set of accounts that can be presented for auditor to carry out its statutory duties upon. And this responsibility also lies with the directors of the companies. Now, for income tax returns for individuals, individuals have to file their income tax returns to the State Inland Revenue Service of the state where they are residents. So if you are resident in Lagos, you do business in Lagos as an unincorporated entity, you are supposed to file your returns to the Lagos State Internal Revenue Service by 31st of March, which is just a few days down the line. And the return is to show or to disclose to the tax authority all income from all sources. So the disclosure is not only limited to income sources that are liable to tax, it covers every single income source, whether it is liable to tax or not, or whether it should be treated as final tax. For example, dividend. For someone that is earning dividends from its investing activity, is supposed to disclose the dividend, the amount of dividend that has been paid, and then the deduction, the returning tax that has been deducted from the dividends will also be considered as final tax. Then for employers of labor that have employees in their care and to whom salaries have been paid, they also have to file what we call the payee return, which is due no later than 31st of January of every year. Then for VAT, withholding tax, payee returns, etc., by the 21st of every month, that has to be done, whether or not economic activities have taken place or not. And it's very critical that these obligations are meant to avoid running into penalties and interest. So it's to quickly run through. So as a business owner, upon incorporating or registering your business, the first thing to do is to ensure that you are registered with the tax authority. And the registration will also cover for VAT, for your company income tax, depending on how this business is structured, and you obtain a taxpayer ID. Then that taxpayer ID must be used in all filing all correspondence returns and on all documents. As earlier mentioned also, accounts must be maintained. Now that account is just to give an overview of the financial position and performance of the business. So it must be such that the tax authority will be able to determine the tax liability of the business, because the profits will determine tax. And for losses also, losses are treated as a carry forward that can be used to even reduce taxes that may arise in future years. So it is important that the accounts must be kept in English and retained for a minimum period of 6 years. Then for the taxes which I have earlier mentioned, they must be promptly deducted, and when deducted, remitted within the appropriate time. So we have mentioned that for paying VAT withholding tax, they must be remitted by 21st of the month. So that means that like 4 days ago or 3 days ago was the deadline for the one that for deductions that may have arisen in the month of February. Then 5, self-assessment returns. Companies, individuals, they are supposed to file their returns without any notice from the tax authority. Then tax authorities, they undertake periodic review. The profile taxpayers the right requested for information, clarification, etc. It is important that these correspondence are properly attended to in a timely and accurate manner. Then the mistakes that SMEs make, we've spoken around them, I will re-emphasize. The first thing is poor record keeping. Because it's a new business, the challenge of wearing so many hats, being the social media manager, the sales marketing manager, the head of HR, everything all tied up in one. But it doesn't mean that records cannot be properly kept. These records, I just see it as a line of defense to say that this is where my position, the position where my company sits or my business sits. And more than even that, it is critical to mention that it is very, very important to have your records, financial records in good order, because it will help you to scale your business in applying for financial loans, grants, etc., you need your financial records to give an overview of where the business starts. Then, in even conducting business, such as under the law, to be able to contract with government agencies, must be able to present your tax clearance certificate, and you won't be able to obtain a tax clearance certificate if you are not in good standing with the law. Then poor internal processes. It is possible because of the overlap of functions that the proper person to make the filing is not in the loop of what has happened. Oh, somebody left and the person was not removed from the someone was employed and the person was not timelessly included on the payroll, such that for maybe 2 or 3 months payee was not deducted from his pay, meaning that for those 2 months there is an under-remittance of payee. So there must be a synergy between all the departments to ensure that what is being reported is correct. Misinterpretation of tax laws. It is possible to file returns that are not accurate, maybe because for wrongly assuming that some tax exemptions apply and which should not apply. Taxes will place a demand on funds. So it is important to ensure that tax payments are planned to avoid default, because default carries penalties at 10% and interest at about 27% estimating it. Then you must know when to file your tax returns, your any tax obligation. You must have a calendar to guide it so that whoever is the responsible officer will know when and what to do per time. Then another critical thing is about ensuring that for every business decision that is made, the tax implication is considered. Imagine disposing or entering into an agreement, then for many years the document was not stamped, and you now need to rely on that document to prove your rights in that contractual arrangement. If the document has not been stamped, you will need to tender it in evidence in court, judicial proceedings, or in arbitration. So these are the penalties I earlier spoken about, and we can quickly run through. I'll just speak to two, then we move on. Failure to register, it carries a penalty of 50,000 in the first month, 25,000 in the second month. Failure to file return, 100,000 in the first month and 50,000 in the subsequent month, on and on and on. And it's important to know that these penalties will keep on accruing even until the default is rectified. So it's possible to have penalties running into millions, even though the business has not even done any profitable business. So it is a very big thing to avoid as a business owner. Now, in summary, just quickly run through what we've spoken about. When you register for tax, when there are changes in the structure of the business, they are just notified the tax authorities. Then when there is, keep track of your compliances, ensure that as a business owner, attending this kind of webinars and events will help you know and to know your obligations and how to apply the tax rules. So continuous training is very important because tax laws keep on evolving. They are public circulars, they are public notices, they are demands. Letting taxpayers know what to do per time, or maybe a slight tweak on how compliance should be done. It is very important to stay updated on these changes. And when you are clear, please seek guidance, obtain professional advice. Is it possible to engage the tax authority by obtaining what we call an advanced ruling? That clarification will help you reduce future disputes and help you run your business in good faith. You will be clear on the direction to go and ensure that all these tax risks are identified early by embedding tax into your operations. For each critical business decision, ensure you are asking questions. What is the tax impact on it about this? And like I earlier mentioned, tax runs through from the beginning to the very end. Even from business incorporation, you have to register. When you are for every business transaction, you have to report. So it shouldn't be an afterthought. It is very important that taxes should be managed, and one of the key things to manage it is by knowing what to do. And when you are unsure, you can get professionals to guide you, seek advice. The Nigerian tax space is evolving. There's increased digitalization efforts by the authorities and enforcement drive. And it's very important that you are aware, you take proactive steps to ensure that you are running a truly profitable business that will be able to scale irrespective of the tax demands. Thank you very much for this time.